Hi guys, we're going to do insurance, and our insurance is going to link to our inventory as we have done before. Now, the first thing is that insurance is applicable when there is any inventory losses. So when can we have experienced the inventory loss? When the inventory is destroyed by fire or other damaging events. And then if we are insured, we can claim from the insurance company. Now, the first thing that we have to determine is whether we were sufficiently insured or not. Now, how are we going to do that? We're going to look at what the closing value of inventory was just before the event took place, which caused the inventory loss. Now, in many of these questions, the first thing that we have to do is to calculate the gross profit percentage, which we all know is the gross profit divided by the turnover. Then by using the cost of sales formula, either opening inventory plus purchases and purchase-related costs, less closing inventory, we can, as a balancing figure, determine the value of our closing inventory. So at the end of the day, we can estimate the value of our closing inventory. Now, to determine whether we were sufficiently insured or not, we are going to apply the averaging clause. Now, in the averaging clause, we're going to take the insured amount, so for what amount are we covered for with the insurance company, divided by the value of that closing inventory just before the event took place when it was destroyed, multiplied by the value of the goods destroyed. It is not necessarily that all the inventory on hand was destroyed at the time of the event. It can only be that a portion of our inventory was destroyed. For this portion of the value at the time of the loss, we need the total closing inventory just before the loss took place. But for this one here, the value destroyed, that would then be the actual loss that was incurred. Now, if we are able to sell some of that damaged inventory to the outside world, and obviously at a reduced price, the insurance company says, but you have to deduct from your insurance claim that you're going to lodge with us the reduced selling price of those goods that you are still able to sell. And it makes sense because you cannot claim for something that you can recover from another third party. So therefore we can only claim what the actual losses was that we're going to incur. Now let's take an example. A fire broke out on the premises of Capital Limited on 31 March 29 and all activities ceased for a period of 3 months. The following information is provided to you. The entity has an insurance policy for inventory to the value of 32,000 Rand subject to the averaging clause. The financial year end is 30 June and during February of each year, goods are sold at a public auction on which a gross profit markup of 25% on cost is made. So the auction sells in 28 is 128,000 and in 29 256,000. Now, why all this information? Why is it important that we know that? Now, the first thing that we know is if we think about our cost price of plus profit equals selling price, means that we have plus profit equals selling price. We know that if there was special sales, a special profit percentage has been applied. So we will have this formula for special sales, and we're going to have this formula for normal sales. And normal sales and special sales. So each one of them, we will apply their own profit percentage in order to work out what was the cost of goods sold, either for normal sales and for special sales. Now, during the fire, all inventories other than that in the showroom with a sales value of 25,600 Rand were destroyed. Why do we give that information? Well, we need that information because the value of the insurance claim will be lodged on the amount of the actual losses that we have incurred. And if some of our closing inventory could have been rescued, then it means that was not a loss for us. So we have to deduct it somewhere from the total value of closing inventory. They give us the inventory on hand as at the beginning of the year, and they give us the inventory on hand as at the end of the year. Now remember, the end of 36/28 will be the opening inventory for the financial year ending in 29. Now the information extracted from the accounting records, they give us the total sales of 1/7/27 to 36/28, i.e. last year's sales, and they give us last year's purchases. They also give us the same information for the current year up to the date that the loss has incurred. And they want from us to calculate the value of the insurance claim that Capital Limit has against the insurance company. Now the first thing that we should determine is what was our normal gross profit percentage. Now they gave us the sales 1,228, there it is 1,228,800. We say, well, cost of sales here, cost of sales would have been our opening inventory, which was 153,600, plus purchases, and they gave us the purchases price of last year, 902,400. That gives us available for sale 105,600, the two of them together, less the closing inventory, which we also have, which was 128,000 Rand. So if we populate that all in this little format, which is our income statement format, sales less cost of sales equals gross profit, we can now start determining what was gross profit percentages. Now this was our total sales figure, but then they've told us here that included in our special sales, or in our normal sales, was special sales for the year. And they tell us in 28, the special sales was 128,000 Rand. So coming back to this calculation, we say, well, if we're going to split our sale into special sales and normal sales, the special sales was 128,000. Now, just to do a simple computation means that the difference between these two would have represented our normal sales. Now, cost of sales in total was 928,000 Rand. Coming back here, they tell us that in the special sales, we had a gross profit markup of 25% on the cost of sales. So if we have the sales, which is the special sales of 128,000, it means if we talk about our auction profit percentage is 100 plus 25 equals 125. So by implication, that means we can work out the cost of sales applicable to that sales of 128,000. So the cost of sales would have been 100 divided by 125 multiplied by 128,000, and that would have given us cost of sales of 102,400. That means if we have the cost of sales of the special sale and we have the total cost of sales, we can now calculate what was the cost of sales applicable on normal sales just by subtracting 102,400 from the 928,000. So that means then that the total normal sales was 825,600. If we have the cost of sales, we can work out the gross profit. So the one that we're really interested in is the normal gross profit. That less that equals 275,200. So now if we have for the gross profit, we can work out what was the gross profit percentage, which is 275,200 divided by 1.1 million, which gives us 25%. We could also have taken the 275,200 and divided it by the cost of sales. So that would have meant that the gross profit based on the cost price of the goods would have been 75%. Okay. Now we can go forward to the next financial year because we know what is the normal gross profit percentage. They told us that the auction sales, that markup percentage remains exactly the same. So therefore we can apply that to the current financial period. They told us that the total sales of the current financial period was 768,000. They also told us that the special sales during this period was 256,000. So we have that information. So taking the 768, take out the special sales of 256 will give us the normal sales of 512,000. Opening inventory will be the closing inventory of last year, 128,000. Purchases, they gave us the purchases 524,800. So I can put in purchases. We've got available to sell those two together, 652,800. What we don't know and what we want to work out is the value of our closing inventory just before the event took place. But we can work out now total cost of sales. How? Well, we know that what is the profit percentage on the special sales? That is 100 divided by 125 multiplied by 256,000, and that gives us 204,800. So our gross profit will be the difference between those two. We can work out now what is the cost of sales on our normal sales just by applying this gross profit percentage that we've worked out here. So by applying that 25% of 512,000, we get 128,000 Rand. So that less than 128,000 Rand gives us 384,000. Good. Now we say, if I take the 384,000, I add the 204,800, that will give me my total cost of sales, which is 588,800. If we have total cost of sales, we have all these figures, then the balancing figure will be our closing inventory of 64,000, and that will be the value of our stock just before the event took place. Now we can continue and work out what was the value of inventory destroyed. Our closing inventory was 64,000 Rand. The question tells us that all inventory with a sales value, and that will be a normal sales value of 25,600 Rand, were salvaged. So that means I have to convert that into a cost price because inventory is shown at cost. So 25,200, here's our normal profit percentage, 75 plus 25 equals 100. So 75% of 25,200 gives us 19,200, the cost price of the goods salvaged. So the difference between the two will be the actual loss that we have incurred. If we want to work out the insurance claim now, we're going to take the insured amount, which was 32,000 Rand, and that they give us somewhere in the question as well. Let's have a look. 32,000, that was the amount that we were insured for, divided by the value of the closing stock just before the event took place. It's that 64,000 that we've worked out there, multiplied by the loss incurred, which was 44,800. And that then gives us the value that we can claim from the insurance company, 22,400. Now, if the entity was a VAT vendor, then the amount that we're going to claim from the amount that we're going to claim from the insurance company is going to be a VAT inclusive amount. So we will claim then 2,400 multiplied by 1.15, and that equals an amount of 25,760 Rand. What are we going to do in our books? We're going to debit the insurer 25,760. We are going to credit VAT output with the difference between the 25,760 and the 22,400, which gives us 3,360, and we're going to credit our inventory with 22,400. Good. And that takes care of insurance.